Hey traders, Raghee here, and in this free video we're going to talk about bonds, the bond market and the breakout in the bond market, and what we are looking for next. But I also want to talk about the implications of the breakout in bonds and what that might mean to other positions that you have, namely in equities. All right, let's get to it. First of all, the market has been waiting for a clear signal from the FOMC, and we could argue that we finally got it yesterday. Was it dovish enough? That's the bigger complaint. But the bond market, as well as the September Fed Fund futures, which is the FF futures contract, continue to suggest that we're going to see another 25 basis point cut in September. And why wouldn't the equity markets like that? So as we see the bond markets continue to rally, which is long bond short yield, that short yield narrative is going to continue to support the equities markets. Now you might say, well, Rog, did you not see the market today? Where's the support? Remember that as we look at the S&P futures and the NASDAQ futures, yes, they are testing the lows from yesterday, but it's a new narrative that we're dealing with right now. It's a narrative that bonds may not care about, hence they're moving higher, which is a long position that we've had for some time. The reason the markets are sitting where they're sitting right now is a narrative that we've seen before, which is the narrative of yet another ratcheting, this time of $300 billion of goods from the Chinese that is subject to a 10% tariff on the 1st of September and up to a 25% tariff, so says POTUS. Now we have seen this merry-go-round of tariffs come and go, and nearly every time the equities markets sell off, crude oil will also oftentimes sell off, which is great. I believe crude is going to be heading lower, and we'll talk more about that in the premium video. But the equities markets typically give us a buying opportunity when there is this kind of tariff-driven sell-off. So keep an eye on the NQ for potential buys here. And as long as the 30-year bond and the September expectations from the Fed Fund futures point to another 25 basis point cut, the way that I'm building my positions in S&P, NASDAQ, and even the Dow is still to stick with the buy the dip. Now you might say, Rog, this may not look like a dip. It is, and this goes back to Charles Dow 101. Remember, broken uptrends are not downtrends. So even though we broke the uptrend here with the first red grab candle, all we're doing now is transitioning to where are we going to see an oversold buy. So remember, because we could see a lot of wiggle in this area, be a little bit more risk conscious and buy YM futures calls, or you can go with the DIA. Same thing goes with the NASDAQ, buy NASDAQ futures calls, or go with the QQQ. And then with ES, go with the SPY or the S&P futures calls. The calls will give you a little bit more latitude to handle some more volatility. I would not go closer than September 20. We'll talk about all the details of that and more in the premium video. But in the meanwhile, keep an eye on the bonds, stay bullish to broader markets, and I'll see you in the next update.